So is this breakout here just a big old bull trap ahead of the CPI inflation report coming out tomorrow morning at 8:30? It's a possibility, but as we'll uncover when we look at the underpinnings of the S&P 500, some meaningful bullish developments have been taking place out there, and I want to show them to you. We'll kick things off on the SPY daily time frame chart, but I would just remind you before we do so that a quick thumbs up on the video goes a long way to support the channel. Let's dive into the price action structure, location, psychology, all of that good stuff. Here was the balance area, and of course we've broken that in the upward direction. That's not new news, that's old news. But if we think about a target from a balance area breakout, we're always looking to double the range, and as we talked about in the weekly watch list video from Sunday, we were looking to hit 394.50 and roll over off of it for a lower high. As of today's close, we have closed above 394.50, and it's not so clear anymore that the overhead supply, the bottom end, the prior support, will now offer resistance. On Monday, it was looking much more promising, but as of today's close, not so much, right? So this is a bullish data point closing above that target at 394.50 and also back inside of the overhead supply here. I would also like to point out that the low of Tuesday technically breached the inverted hammer low of Monday because this was looking solid for a lower high, right, from here to here, short underneath the low, and see if we can get back down into the balance. It simply never took place. The low of Tuesday wicked right above 385.50. No opportunity for the sellers to take advantage of a look above and fail, and instead we got the follow through on today's session for the breakout. So technically, we have a low here, a higher low, break, retest, respect the top of the balance, and we've closed away from it in the upward direction, as we've pointed out, above the target at 394.50. So those are some bullish data points from a structural perspective. If we think about indicators and we throw on the anchored VWAPs, we are now above all of the anchored VWAPs to the 2022 dips in this zone, as we've talked about, as resistance. This white one here is from the last CPI report from December, and we're also above that anchored VWAP as well. It doesn't guarantee that the market must move higher, but instead of a force for resistance, and instead of these buyers feeling like they're underwater, they're now seeing some green in their portfolios, and they may have an incentive to add to these positions if prices continue to improve. So no longer is that a bearish resistance point. Let's go back on over to the moving averages, and I would also just point out, sort of in conjunction with those, we're of course above the daily 50 SMA, the blue line on our screens as well. We're also above the thick white line, which is the high volume node of the weekly time frame chart, and we're fast approaching the daily 200 SMA, which is confluence of resistance towards the top of the weekly expected move. Now, because we are approaching the upper edge of the weekly expected move, I would say, and also because we've hit the target and some from the break of the range, now may not be the time to be looking for new money longs, but it's hard to ignore the bullish structure that's starting to unfold here. So positioning for new longs here, maybe not ideal, but thinking about pullbacks that start to find higher lows, that could be something to have on your radar, especially as we start to uncover some of the information in the sectors, as well as the internals, which we'll get to momentarily. However, I want to bring your attention to the Fibonacci's and then the hourly time frame chart. If we come in from the high here to the low, remember that we had continued to build the case that the 38.2 would have kept us in bear flag consolidation, something that would have possibly broken down in the future. We have now closed well above the 38.2 as well as above the 50% mark, so no longer are we in bear flag consolidation from that perspective. And if we scrunch this chart up like this and come from the low to the high, one of the data points that we had been looking at prior was being in quote-unquote no man's land in between the 38.2 and the 61.8. The bulls are now much more content being above this 38.2 right here. Again, not a guarantee that prices need to continue higher, but these are some bullish data points that are starting to stack up, and I would not ignore them per se. Let's have a look at the hourly time frame chart. Here I want to show you trend primarily, and again, probably an argument to not be overly bullish and be looking for new money longs up here at the highs. Whenever we're playing a trend, you generally in an uptrend want to be a buyer of the higher low or a buyer of the break of the equal high. Do we have the possibility for either of those things right here up at the top? Not really. You don't really want to be buying the higher high. Instead, a pullback at this point in time wants to hold over 389.50. That's the weekly level of prior resistance, now potentially offering support that would keep us in an hourly uptrend, right? Here's the balance, break, retest for a higher low. Higher high is produced here. The next higher low probably wants to be somewhere above 389.50 if this market is going to remain bullish. If you're a bear, what you want to see at this point in time is a failure of this level right here and a rotation for a lower high back into the balance range to send the market lower in the future. That would, of course, produce on the daily time frame chart more of a head and shoulders type pattern that looks like this, with a slightly higher than ideal right shoulder, but nonetheless breaking down underneath the neckline. That, of course, is where we start looking for the equal lows on the weekly time frame chart, reaching that 355 objective, considerably further in the south direction as opposed to where we're trading currently. Now, again, CPI comes out tomorrow morning at 8:30. We're not positioning ahead of that. As a matter of fact, it's too late to position with options at least ahead of that. We're completely flat headed into the announcement, and we'll take it with a grain of salt. If the market moves higher, we're willing to observe and possibly take part in upward reactions. If the market moves lower, we have the levels that we're watching out for and the possible scenarios. Just to sum it up one more time on the SPY hourly, a pullback if CPI causes a big sell. Anything that remains for a higher low above 389.50 is actually quite compelling. Here's another bullish data point that I didn't really discuss prior. The fact that this morning we gap up and we only got a partial gap fill on this morning's session. Right? There's a little bit of gap that did not fill all the way. That would be an indication of the sellers failing to move through the virtually zero structure, thin structure, to close the gap all the way and tag up to the prior high of day. So if the sellers aren't doing their job, the natural buying activity of the market takes over and we move higher. Right? So there are some compelling reasons why the buyers are making a meaningful breakout here, but it goes deeper than just looking at the price action. And again, I would not be an advocate for new money longs if we gap up big time on CPI. We're running into overhead resistance at the 200 SMA. We're possibly extending through the weekly expected move. You're just positioning very poorly if you're trying to get long here without a risk-friendly pullback first, right? Remember what we just discussed, getting in on a higher low pullback or a higher high breakout. Let's take it one step further and uncover some slightly more bullish data points as well here. We're going to try to keep it very balanced, but again, when the data points have stacked in front of you in this manner, it's hard to not have more of a bullish tone. In terms of the inflows for the week, we're already positive to the tune of where we were at the close of the prior week. Now, traditionally, for this to be a really bullish indication, you want to see about $1 billion on the inflows by Friday's close, and we're well on track. We have not breached the 300 million mark on the intraday reads, but you can clearly see that all of these have been meaningful in the upward direction. Certainly some positive inflows to the market over the past weeks or 3 days really worth of trade. The advanced decline line is also quite positive, staying above the zero line for a majority of the week, only getting a little bit tangled up on the Tuesday morning session, but up in trend zone throughout the majority of today's session, which was the cleanest trend day in the upward direction. The cumulative build on the tick as well is always where, there's no hiding. You can't hide from this indicator. And by the way, if you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. But the cumulative tick, look at this thing. On Monday, even after the sell, so let's grab another day here, so I can show you this. This is really important, right? Even after the sell-off on Monday, right, that was fairly aggressive, the cumulative tick does not go negative. Tuesday, it's a solid build. Wednesday, it's a solid build. Both of those instances over the 4,000 read, over 2,000 by noon. Really solid buying activity across the entire exchange. This, to me, is actually indicative of new money buying. This is not short squeeze. This is not short covering. This is not, frivolous short-term traders sending the market all over the place. This, to me, actually looks more so indicative, paired with this type of volume flow, paired with this type of advanced decline line, as new money buying. So again, the argument is not that the market goes and makes all-time highs in the next couple of days, but this rally is starting to become something that we may want to respect. And instead of looking for the lower highs, it's like, okay, let's see how this plays out, right? Maybe we need to give this a little bit more respect than we originally anticipated, looking for that lower high. Let's have a look at the market profile. This is where we're starting to say, okay, let's tap the brakes a little bit on the bullish narrative, simply because of where we closed the point of control on today's session. And once again, if you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. Point of control closed weak, really low in today's range, as did the value area. It did not really shift higher with price as we sort of rallied into the close. So is that an indication that maybe the buyers are getting tired up here and they're not committing as much volume? Yes, from a data perspective, they certainly aren't committing as much volume up there, but from interpreting their intentions, I would say, again, it's probably folks not wanting to be overly long at poor location as we head into the CPI release tomorrow morning at 8:30. So this would really be a data point that says, point of control, sure, it was higher on Monday. It followed through. It closed at the highs even after the sell-off, right? Tuesday, fairly neutral. It did technically migrate higher here to here, right? And we can see that gap, certainly still open from there to there. So the point of control did move higher, but on today's session, it was left low in the range. So again, an indication that, yes, there's more of a bullish tone out there, but probably not to commit too much volume up towards the highs, which is noteworthy. Right, that is noteworthy that people are a little bit skeptical getting long up into the CPI release tomorrow morning at 8:30. Comfortable down here, not so comfortable up here. One of those data points that's like, hey, probably tap the brakes just a little bit on the bullish narrative thus far. Let's get back on over to the platform, and I want to, of course, talk about the sectors. We're seeing some really important things here. This is the percentage change on the week. It's just easier to do this than screenshot the other visual that we had looked at in the past. Regardless, I want to point your attention to the fact that some really heavyweight risk-on sectors are actually up towards the top, namely the improvement in the XLY. Really, really important. Of course, real estate's up towards the top of the list as well, but the XLY is the most meaningful. So let's walk through these sectors now. This is the XLRE real estate sector. It's not overly heavyweight, has much more to do with the wealth effect as we've talked about in the past. And the fact that it's over 39 is definitely a positive indication for the wealth effect. So looking for this to continue higher would be more meaningful for the American consumer to feel more confident in their spending. The wealth effect is kind of up. If we fall back down into range, it's really more neutral. It's not necessarily a bearish data point for the market. Next up is the XLY. This is where some dramatic improvements have been made. Notice that Monday's session, it's really today's video is all about the fact that Monday's session did not produce a lower high, even after printing an inverted hammer. Right? It's textbook. Inverted hammer right off of the prior bottom end of the range, should have found a lower high given that this was all overhead supply, right? And done something like this. The fact that we take out Monday's low, no acceptance from the sellers, no push back down into this range back here, and now we've closed back inside of the technically, a little bit higher range if you want to disregard some of these lows. Really, really impressed with the XLY. This had been a sector that had been a huge, huge headwind for the market. So to see this improvement, to see it really picking up on the week, at least leading the week in the upward direction, really, really solid. And we'll see that in the ratio relationships momentarily as well. Of course, if it falls back down, I'm not saying that it can't produce a lower high, but as of right now, it's definitely steps in the right direction, which again, maybe we should respect this rally more so than just blindly saying, oh, nope, we're going to short it. First sign of a lower high, it's got to go lower, so on and so forth. All right. Next up, XLK. What do we see in the XLK? This is where it's like, all right, some outperformance on the week, up 2.63%. However, we're still underneath the overhead supply. So unlike the SPY itself, it has not recaptured its 129.50 level. It's definitely, on trajectory to sort of get there, but one step at a time. If this finds a lower high underneath, that would, of course, be a bearish data point for our market, cleanly respecting the structure and just obviously offering a lower high, right? That keeps us bearish on the S&P if the heaviest weighted sector, the XLK, can't recapture 129.50. So we've been fairly bullish so far. This would be a bearish data point to start to sort of balance the analysis just a little bit. We're not all the way there yet in the tech sector. Next up is the XLB material sector, really lightweight. We don't want to read into it too much. Back up in here, right? So certainly the recapture of 80.75 is a bit more meaningful. I would say that if this starts to make new highs, that's where it's a bullish force for the S&P. Just being tangled up in here, prior area of congestion, not all that meaningful, but definitely steps in the right direction. Obviously, a bullish force on the day-to-day. It's just overall for the market, it's such a lightweight sector. We'll keep on moving along. Next up is the XLC, communications. What do we see here? More outperformance. This is definitely more of a risk-on sector. Although it's not heavyweight, it is indicative of risk-taking activities. And look at how it's made the move basically from the bottom and staying underneath the overhead supply. That was this area here. No pullback, straight to the top of the range. It's very, very difficult to say that this is not a bullish improvement for the S&P 500. Now there's a clear opportunity for a higher low pullback somewhere anywhere above 46.60. If this offers a higher low and reattempts the top of the range, this is just asking for the most perfect pressure cooker top breakout to possibly send the S&P slightly higher. Right? So this is definitely a big improvement for our markets. XLU, what's going on with utilities? This is a risk-off sector. This is D for defensive, and it is actually breaking out over the top of the range here. So it's not a great-looking data point for the market in terms of leadership. But remember, at the end of the day, any upward pressure is still upward pressure for the S&P. We just don't want it making new highs here, and we don't want it outperforming, which, as we'll see on the ratio grid momentarily, it's not outperforming as of right now. Next up, we've got the XLI for industrials, right up back towards the top of the range. This was a really powerful force for the October rally, of course. The fact that it's right back up here towards the top after putting in, you could argue that this is like a monthly or even a weekly higher low set up here. really great look. Really great look. Watching for, ideally congestion and then a break into the future, you would get much more of that cup and handle type look, call it a bull flag in the late stages here, and getting continuation. The fact that these sectors have not really, seen a fake break of these prior ranges here where they were getting consolidation, it's really indicative to me that, hey, something meaningful is actually happening. We can't just be full-blown bearish based on the sectors, at least, yet. Okay? So let's have a look at the XLF. XLF, one of the same sort of ideas and principles, break of the triangle right back up towards the top. This is the third heaviest weighted sector in terms of market cap. Really powerful force for the S&P 500. This is a risk-on sector as well. This is saying, hey, we're well outside of this troubled area here, making some steps in the right direction. Another reason to respect the rally. Next up, XLP. What's going on here? This is a risk-off sector. This is D for defensive. It's lagging. It's in, if you want to consider this as a balance area, it's in the lower 50%, right? So it's underperforming the market. This is a decent look for the S&P. We don't want it plummeting into the ground, but we certainly don't want it outperforming, and that's exactly what it's doing. Nice there. Next up, the energy sector. What's going on with the XLE? Same idea as the XLP that we just discussed. This is D for defensive. It's kind of stuck in the middle here, stuck in the middle with you, right? Anyone? Regardless, the more it goes sideways here, the better the look. We don't want it plummeting to the ground, as we just pointed out, but we also don't want it vastly outperforming, and it's doing exactly as it should. Next up, we've got the XLV for the healthcare sector. What's going on with healthcare? It's holding up just fine. It is D for defensive. However, the difference between this and the other defensive sectors is that this is the second heaviest weighted sector by market cap, so we actually need it to participate in rallies, although it is D for defensive. So the fact that it's holding in here sideways actually strikes me as okay. And you could also look at this as a look below and fail. Look below, fail. We've gotten back up into this range here. If we can get to the top, it's again looking like a clean pressure cooker top. Breaking that should send XLV slightly higher back up towards that 142 top of the monthly balance at the highs. Let's have a look at a ratio grid now and see how the relative performance is continuing to unfold. If you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. The top four are the risk-on sectors. Notice the improvement in the XLK. Not out of the woods by any stretch of the imagination. I don't want to be overly bullish on this data point. It's improving off of the lows. It's not all the way risk on yet. So steps in the right direction, but not there yet. XLV, unfortunately, coming underneath the 50 SMA, the upward sloping 50 SMA. This is the gold line. Not great from a risk on look, but we know it's D for defensive. If we want to see any one of these sectors lagging, it's probably the XLV. XLF coming in slightly towards that upward sloping 50 SMA, still in a clear uptrend with higher lows and higher highs being formed, looking for that next higher low in the ratio. And the XLY, look at the improvement. Again, I don't want to be overly bullish. The structural chart does look good and the performance looks good. It's still unfortunately in an overall downtrend, and this is a counter trend rally. This little, let's get rid of that. This little up move here is a counter trend rally until proven otherwise. So it's looking good. It's steps in the right direction. It's a reason to possibly respect the rally slightly more. But until proven otherwise, not all the way out of the woods yet here. So in terms of risk on as a summary, it's improving, but it's not all the way there. In terms of the bottom four, these are the risk-off sectors. The XLP is rolling over here. I'll show you that weekly chart in a moment. Really powerful look for more of a risk-off turning off type look, right? Energy continues to go sideways. That's a nothing burger here. Utilities, as we pointed out, although we got the breakout of that pattern on the structural chart, the relative strength is coming in, and real estate is perking up just a little bit. But again, this has much more to do with the wealth effect. This is where I want you to focus. XLP really coming in off of the weekly resistance trend line. Let's have a look at that chart here. We pointed this out in the Sunday weekly watch list episode. There's the anchor. There's the first touch to consider the trend line, and we're rolling over off of it. Now, usually when the XLP peaks, it coincides with some sort of bottom in the S&P 500. And it doesn't have to be one of these peaks off of the trend line. If you look at the peaks back here, coincides with your 08-09 bottom. If you look at some of the peaks in here, the volatility from 2011, some of the peaks in here, some of those dips that you're seeing, they're very, faint on your screen, I'm sure. But regardless, when this ratio comes in, remember that it's all about the defensive posture, not evaporating from the market, but slowing down, right? Slowing down. And we are seeing that as a data point stack up, which is actually bullish for the market. Speaking of bullish indications, this is one that we have not had a bullish comment on for quite some time. This is the XLY growth versus value. Look at the break of the resistance trend line. For a while, it had just been, okay, we're making a counter trend rally, counter trend rally, counter trend rally. until proven otherwise. Break of the resistance trend line, this is actually bullish for equities. Right now, the question becomes, can we find a higher low somewhere on the opposite side of the trend line and recapture the descending 50 SMA? That's the gold line on these ratio charts. So just as a brief reminder, I know I sound like I'm bullish this, the market's going to go up to all-time highs. I'm just pointing out that the data, the evidence in the actual charts is starting to change from a full-blown risk-off bearish look to, hey, maybe we should treat this breakout with a little bit more respect than we would have otherwise thought. And this all could change tomorrow morning at 8:30, which is why we'll update you again tomorrow after the close. But these are the, sort of pertinent facts that I need to bring to your attention, right? So far, this strikes me as a big improvement to this ratio relationship here. Let's have a look at the dollar. We've been calling the bluff of the dollar because of the gold breakout particularly. And it's actually worked out. The dollar has moved lower, which as we know is actually a bullish force for equities. And gold continues to move higher on its breakout. If we have a look at the GCs, you can see this is much more meaningful. Right? This higher low pullback looked good. We're hanging out high now, looking for prices to improve. Now, some comments from a fundamental perspective would be that if the dollar continues to weaken here and actually drives lower under the 105 in a more meaningful breakdown type way, like something like this, we're mirrored in here. Of course, that's an inflationary pressure, which what would the Fed have to do about that? They'd have to come out with their hawkish stance and try to beat the market back down, which is what we might see if inflation comes in as a miss. So speaking of that, let's have a look at some rates here. TNX is up first. Let's go to the signal study because it did fire off with a bullish cross today in the downward direction from positive to negative. It just means that the rate of change here is substantially moving in the downward direction. Remember that as of the weekly watch list video from Sunday, the most important part about this chart here is watching to see if we produce a weekly lower high, and that's kind of confirmed if we can get a breakdown of roughly 3450, which is 3.45 in your rates. All right, 3.45 in the TNX, right about here, 34 even, 34.50, somewhere in this area. We basically need the next new lower low to confirm a weekly downtrend, and that would be meaningful for rates, which, as we know, possibly lifts the pressure on the TLT. Right, and the TLT can start to move in the upward direction, which would be good from a business cycle perspective. But something I want to point out to you is that from a relative performance perspective, the TLT, the bonds, are not outperforming the SPY. So we're not seeing a classic flight to safety. This is not indicative of like bearish, let's all jump into bonds because we think that the market's going to collapse here. If that were the case, you would see this blue line. These two things can move in tandem in the upward direction. But if the blue line is aggressively pointing higher here, that's much more indicative of your flight to safety when we see that outperformance. Speaking of rates, let's have a look at the meeting probabilities. All I would point out here is that the market continues to call the bluff of Jerome Powell, and we can see that. Oops, where did my drawing tool go? No idea. Looks like we're out of the drawing tool. There it is. You can see here, terminal rate. Whoa. Terminal rate. There we are. Sorry for the hiccup. Terminal rate set to be 500 basis points, right? 5%. And then we're starting to get rate cuts as of, what would this be? November of 2023. So remember that as long as the rate cuts are being priced in, it's an indication that the market's kind of fearful of a possible earnings recession. The Fed will have to come bail us out, and we'll see what happens, right? There's a really high ask of the sort of economy as of this point to produce a really solid CPI print tomorrow morning. If we go ahead and have a look at the expectations here that we've sketched out, we know that the market is expecting negative growth, so deflation in the month-over-month read to the tune of negative 0.1 of a percentage point, and the expectation for the year-over-year is 0.65, dramatically underneath and continuing this downtrend here that we're seeing in the year-over-year, which is what the market and what Jerome Powell needs to see to possibly, continue the. They're going to have the hawkish tone because they don't want the market to get out of control, but maybe in their back pocket, they're going to say, all right, we'll keep rates, they'll keep it on the hush-hush, they'll keep it in the meetings, but, maybe we'll keep rates at 500. The market's right. We can't really exceed that ceiling. If we do go further than that, maybe bad things will happen in terms of the earnings recession, so on and so forth. So as of right now, really tall order to hit this month over month, but I do think that this is slightly more manageable from an expectations perspective. So something to keep in mind from that point of view. If we miss here, note that bad news will be bad news. If inflation comes in hotter than the expectation, it's just an indication that the Fed will be hawkish, and they'll have an excuse to actually exceed that 500 basis point ceiling that we just saw on the meeting tracker probability screen. If this comes in better than the expectation, then of course the market will continue to be pricing in cuts as of, or towards the end of rather, 2023. Okay, so that's what I've got for you from a CPI perspective. Let's have a look now at the HYG and the risk appetite of the market, because there's something interesting going on here. Remember that this fell off of a cliff, SPY called its bluff. Now the opposite's taking place. The HYG is actually priced in more risk. You can see more risk taking here. If we drew this in as a divergence, this would be a higher high, whereas the S&Ps are nowhere near this peak, right? You're getting a lower high in the S&P. So who will win out this time? The SPY has a decent track record over the past 3 events. However, I think that this is continuing to indicate, rather, that good news needs to be good news and bad news will be bad news. This is a sort of paradigm shift from the macro perspective as to what we were dealing with throughout most of 2022, right? So noting that, this relationship continues to be flexible, and I would not be married to the idea that the SPY has to catch up, this divergence has to play out, and we must make a new higher high here. So again, one of those balanced data points trying to bring us back down to reality. Now that good news is good news, it could easily become the fact that if the S&P stalls out here, HYG comes back in a little bit, and there's your divergence playing out. So just something to be paying attention to. As of right now, yes, this is indicative of risk appetite increasing, but the SPY is kind of calling the bluff and saying, hey, maybe you should chill out just a little bit. Let's have a look at the SPX A200R, just because I want to point out that we've made a move back above the 50% mark. So we spent a couple of weeks underneath, and now we're right back above. So this is a more bullish data point, especially after finding a higher low. It's just indicative that more stocks in the S&P 500 are getting above and now staying above their 200 SMA. So this increase happening here is indicative of, again, stocks that were previously above the 200 are staying above the 200, and more are being added, as we can see in this higher low from here to here. Of course, if stocks are above their 200 SMA, it's very difficult to have a prolonged and drawn out, so to speak, bear market breakdown. So bullish data point from that perspective. If this gets back up here, really above 70% is much more ideal for the market and sustaining bullish pressure. Then the last thing I would point out is something we talked about in the weekly watches video, which is the DJI and the DJT, transports and industrials. This is much more even keel. Remember that transports had been lagging. Look at the breakout that happened here. Much more even keel, not as concerned with the possible divergence between the two. We'll continue to keep an eye on it, but it was really more concerning when this was hanging out down here, and this was readily available to possibly get up towards these highs sooner, much sooner than the transports, right? So now that this is corrected, it's not as big of a potential risk point for our market. Let's move along and have a look at some volatility products, and then we'll move on through the remainder of today's analysis. VIX, what do we see in volatility? Still floored down here at 2050. Remember that as it sort of hovers around 2050, it's indicative of investors and sort of traders being on their toes, not so much that we're out of the woods. 2050 has represented basically where most of the breakdowns from 2022 have taken place. Doesn't mean that we have to do something like this, but it becomes more comfortable for the market if we can actually break down underneath it and not just start holding it as support. Right? We're opening ourselves up to the complacency effect the more that we spend time here instead of continuing the trend in the downward direction. This is also clear if we take a look at the VVIX coming on over here. Notice that it's floored at the 75 level, complacency effect in full swing. Remember that all this means is that expected outcomes will likely be much larger than we could have anticipated. Everyone's rushing into the same thing all at once, spirals out of control. You get a little bit more of that gamma squeeze type activity. If we have a look at Contango versus backwardation, this move has sort of corrected. Remember, we were slightly concerned about this rapid ascent. Now it's sort of corrected and gone sideways. The trend line is no longer really in play, but this has come back into alignment with our 9-day and 30-day VIX down below. So from a volatility perspective, I would just say keep your wits about you. Nothing about this is in a comfortable spot yet, although the Contango here is probably a better thing to see as opposed to backwardation up and over that 0 mark up here. Let's get on over to the QQQ, NASDAQ 100, and round out the remainder of the broad market. Quick tour through the core list, and I've got one additional trade idea to share with you so far for today's episode. If you've appreciated the analysis so far, again, the thumbs up button goes a long way to support the video and the channel. QQQ is clearly much different, has not closed above the balance area lows from in here. It still has to contend with the possibility of a lower high under 281.25, which is exactly what we discussed in the XLK, the tech sector, where are you? There you go, itself. So not out of the woods here, still looking for the possible lower high underneath 281.25. That would be bearish for markets. We are sitting right at the 50 SMA as well as the weekly expected move high. Again, probably not ideal for new money longs here. Even if we do continue a bit higher, you could look for a rejection off of that 281.25. So not as bullish in your QQQ. For higher lows at this point, you would just want to see, honestly, going to the hourly, you can see this. Really, the level is much closer to 270. Higher lows that are above 270 are looking much better. So 274, from the daily chart makes sense, but 270 from the hourly, as we can see, is really much more indicative of the top of that balance. So let's go 270 with that level there. All right, so 270 is your pullback for support. Probably not ideal for longs, possibility for some shorts up around 281.25. IWM, Russell 2000, and the small caps have continued to act as a market leader. Up at the top of the weekly expected move, recaptured the daily 200 SMA, 50 SMA, recaptured the bottom end of the balance here. It's acted as a market leader. It's continued to do so. It was the first to break out of the balance. It was the first to put in really clean higher lows happening here. The break and retest was well above its white line before the S&P. So to me, watch this as your leader. If this starts to pull back tomorrow morning, maybe it's an indication that, hey, we are off the top of the weekly expected move. Watch for things to cool off. As long as this finds a higher low anywhere over 178.50, it's a continued bullish force for the market. This is indicative of risk appetite actually returning the more time we can spend up in this box, or generally anywhere above 177. All right, let's get into the core list of companies. Apple is up first. What do we see in Apple? We've resolved that 130 level in the upward direction. Now it's all about 134.85, these prior lows here and from in here and the back test. So I would not, again, be thinking about new money longs just yet. Intraday pullbacks are good that then retest. From there, that's where the door really opens up. You can see the range is wide open till 140.25. That's the more, that's the healthier range to be trading for inside of Apple. So longing this, not so much. Wait for the consolidation or the pullback that then breaks this area. That's where it opens up. That's where the more profitable trades will be had. Putting in consolidation here is healthy as long as we remain over 130. Failing 130, not necessarily in love with any of this action here. It's been a really tricky market to trade some of these bullish moves. So if we come back down into these ranges, I don't know that I would be able to see it with clarity just yet. We'd have to see how we get there and what type of structure unfolds on the way. Next up is Netflix. This has been one of the cleaner charts for the market ever since it broke the double bottom neckline here, and it pulled back and respected it beautifully. I mean, just great looking chart. 3-bar play potentially in play with a 1, a 2, and looking for 3 to crack over 330 roughly. Your upside target, if we can clear this high set from right around in here, is up towards 352.50. Definitely some positive range to be trading for in Netflix. If it does pull back, you want to see a healthy high or low anywhere that remains above 314. The setup, though, is primed for a break higher with the inside bar in the upper 50% of the prior day's range. So it looks good for a bullish setup. However, if we gap up, might be tricky if the remainder of the broad market is coming in off of the CPI gap up. That's if we beat the expectations. There's no guarantee of that. I'm just throwing out scenarios, right? Tesla's up next. What do we see here? Really lackluster break of the daily pressure cooker top here. It was good for an intraday squeeze. Let's look at it on the hourly chart. We had one nice solid push off of the open. Hopefully you caught a piece. We talked about it in the pre-market prep. And then it was sideways consolidation for the day, closing back down underneath the level. Regardless, the inverted hammer is what has me most concerned. The fact that we wicked above the level. There were no buy stops that were triggered. There was no short squeeze that happened there. So really, the lackluster movement and the close back down underneath the level, I'm not in love with this going forward. I would have thought there would have been a more meaningful reaction there. It simply wasn't. So putting Tesla on the back burner for now, I guess it just continues to be an untouchable for our market. Next up is Google. Google's a really tricky one as well. I mean, just all over the place in terms of the balance. Look at what we have here. Look above, fail. Look below, fail. Look above, fail. Gap down underneath the bottom of the range. Rally, gap up, break the range, and get some follow through. So just all over the place. What I would love to see in Google is some confirmation of a higher low above the top of this balance from here, and then we can play long for the rotation up towards that 94.65. Like, give us some clean structure here. Stop playing these games around the balance area, and then we can make the move and look for the trade. So in Google, I need to see the confirmation before I can be attached to any particular types of outcomes, given the display of the erraticness, so to speak, of the price action over the past couple of days. So really, really tough to pull something off there on Google. Meta, what's going on over here? More like Netflix with the possibility of a 3-bar play up and over these highs. You are running into resistance quite soon, though, at 136.50. So possibility for a scalp there if we open in range and break. With the CPI move, though, it's likely that we will get some kind of gap, be it up or down. I'm not entirely sure, obviously. Otherwise, I would have, loaded the boat, of course, with my magic 8-ball. No, in all seriousness, if we open in range, which seems unlikely, the pressure cooker top is in play. If we gap up, just like everything else we've been discussing, there's the risk of a pullback. Then you would watch for a gap fill reversal. This isn't a solid overall uptrend since the earnings lows back here. It's up like 45, 47% or so. So it's moving quite well. It is up and out of this balance area here, watching for continuation, but it's got to set up something clean. We can't really afford a gap up from this particular structure in here. Next up is NVIDIA. What do we see in NVIDIA? Negating the bear flag. Remember that this was bear flag, opening and staying above this balance in here. 3 days higher, equal tops right across the top here. Break, of course, is over 160.75, 169.50 is your next big target. Again, if we open in this range, it's in play for that particular setup. If we gap up, that complicates things, and gapping down, you would probably just want to watch your risk underneath and falling back down into the range, target the lows, 142.50. Next up is Microsoft. What's going on with Softy? Closing a bulk of the overhead gap on today's session on the sort of partnership announcement, $10 billion for OpenAI and ChatGPT. Pretty cool stuff, but gobbling up these inverted hammers, never took out the lows of any of them, so it does strike me as more bullish than bearish. The trouble is, though, this is kind of a sticky area for Microsoft, and we're running right into that ahead of the economic data drop. I would kind of be patient around this area. I think the move had been had. We were really watching for this gap close on today's session. We got most of it. I think it's a patience play. Wait to see how we resolve this prior area of contention before making the next sort of setup inside of Microsoft. If we break through and higher low above, we know that the target becomes 247.50. If we rotate off of it for a lower high, then the trend remains intact. And of course, the target would be back down towards the lows, much closer to 222. All right. Last but not least, the mini beast. I've got Amazon for you, right back up towards the top of this balance range here. Another tricky one, especially with Monday's inverted hammer that never materialized, never made the move back down into the range, closed above the high, gap and go. Kind of tricky stuff based on the Monday inverted hammer. However, given the strong close here, the argument is just that any higher low pullbacks should be bought as long as we're above 87.75. It's a constructive look. You're building out much more of a possible inverted head and shoulders on the weekly. If you want to be patient, the neckline break would be up around 96.85 to unlock the move into 104 and possibly closing the gap into the future. If you're more bullish than that, right, looking for the pullback buy ideally off of 90, closing the gap. If we go to the hourly, you can see this clear as day. Remember what we talked about on the SPY, right? That doesn't go away. You want to buy higher low pullbacks here or equal high breakouts. That's here, right? It's very, very difficult to be chasing higher highs and have good risk management on the long side of the trade. Last but not least, I've got one singular trade idea for you. And this is just, I think that the fact that I could only come up with one trade idea really shows how the market is kind of stuck in, just a tricky environment. Nothing was really offering a clean setup. Think of what like Google did and all that back and forth. That's what I was seeing in a majority of the scans. But Pinterest struck my eye because we have a clear break of this like zone of resistance here on some pretty strong green candles. Now we have been up aggressively for 1 to 3 days in a row, 4 days if you want to count that inverted hammer mixed in there as well. So again, new money longs up here, maybe not, but on a longer time frame, a break of this balance, technically, if we go to like a weekly time frame chart, and look at this, right? We have this coiling activity, breaking that in the upward direction. Maybe it takes us back up closer to this area in here. That's a little bit of an overshoot, but 33.69, if it's the top, if it's the double of that range, it's 31.50. A trade to start paying attention to, at least inside of Pinterest. Again, a longer term idea, not something that has to play out tomorrow, the next day, or even the next, but over time, the more we spend above 26.35, 26 even, the more meaningful it becomes for a possible rotation in the upward direction. Failing that level and getting back down into this chop kind of turns into more of an untouchable where it's not offering up anything too clean. That is going to wrap up today's episode of the Midweek Market Update. If you enjoyed it, let me know down below in the comments section via comment, or a quick thumbs up goes a long way. As we've pointed out earlier, all the links that we're associated with are down below in the description, and we'll be live tomorrow morning at 8:15 to catch the live market reaction to the CPI data that comes out. Is inflation hot? Is it cold? That is the million-dollar question Wishing everybody a good night and a green trading week.